Many investors are bullish about the coming year. They're pricing in a worldwide economic recovery in the markets. But our next guest says you want to keep a close eye on China and the U.S. He says that two of the world's biggest economies are going to be in a race to see who crashes first. Independent economist Andy Shea joins us on the phone. Andy, by the way, is the former Morgan Stanley chief economist for the Asia-Pacific region. And Andy, thanks for joining us on the program. You're talking about problems in either China or the U.S. that will blow up, but we're talking about very different problems. Inflation in China and too much debt here in the U.S. Which one, in your mind, is more pressing?
Yeah, I think right now, I think the Chinese inflation problem looks more pressing. We're seeing wage pressure and food pressure, and basically prices are going up very fast. But the government is dealing with it, but it's not taking sufficient steps. So hopefully they will be able to be more aggressive in tightening, and that could buy China some time. I think that this inflation problem is, if they are not careful, could become like in '94, and it could cause a hard landing.
Okay.
If China does have a hard landing, it will be beneficial to the U.S. when the oil price comes down. But I think this is not what China wants. So if they do take enough steps, and hopefully the economy can last for the next year or two.
Andy, let me see if I understand you correctly. It's in the U.S.'s interest then to see China fail in holding back inflation? Because you're saying the U.S. could benefit if China has a hard landing.
Yeah, I think that the U.S. monetary policy is really complicating China's inflation problem. The U.S. has the financial system is not functioning well. So the money printing is not causing inflation right away, but it's spreading out into emerging economies, especially to China. So the U.S. monetary policy is definitely very bad for China. But on the other hand, the U.S. has a huge fiscal deficit problem. The economy is not on some sort of self-sustaining growth path. It continues to depend on debt. And with this new bout of debt, afterwards it will be the economy will cool off again. Then it will need more debt. At some point, the U.S. Treasury market will crash.
Right. We hear about all these problems. We hear about all these problems that the U.S. faces from politicians, from bond vigilantes. On the Chinese side, does the government and do the policymakers there understand sufficiently all these risks that you've laid out?
I think for a large economy like China, there are a lot of complicated political issues, and in particular, it's about the property market. The property market is so vast, and the government finance is very dependent on it. So aggressive tightening could cause it to crash. So this is the main reason why the government is only taking baby steps in dealing with inflation. So I think the risk is still out there. Now, it's too early to tell if China can avoid a hard landing.
Can China achieve a soft landing without a property market crash?
Well, I think the government has to accept a significant reduction, a decline in property price. I think that to say the contrary, it would be, let's say, 1/3. And if the property market goes down by 1/3 and it stays there, the economy may not have a hard landing because the infrastructure spending is strong and the consumption is strong. So I think that the government should not worry too much about an economic hard landing due to the property market deflating. But if they somehow tolerate inflation for too long, it could lead to a social crisis, and then the interest rate has to go up a lot. That will cause a hard landing.
Right. All right. Well, we thank you for your thoughts and for your very frightening forecast. Andy Shea, who is an independent economist, joining us by phone from Shanghai.